My topic is customer lifetime value in detail explain, and let's go to the topic and let's go to the start. Customer lifetime value is the total amount of money a customer is expected to spend with your business, or on your products, during the lifetime of an average business relationship. This is an important figure to know because it helps you make decisions about how much money to invest in acquiring new customers and retaining existing ones. Customer lifetime value helps you understand and gauge current customer loyalty. If customers continue to purchase from you time and time again, that's usually a good sign that you're doing the right things in your business. Furthermore, the larger a customer lifetime value, the less you need to spend on your customer acquisition costs. Customer lifetime value, CLV, is a business metric that measures how much a business can plan to earn from the average customer over the course of the relationship. Differences in products, costs, purchase frequencies and purchase volumes can make customer lifetime value calculations complex. However, with the right tools, you can find customer lifetime value in just a few clicks. With an understanding of CLV, you can make better informed marketing and sales decisions, among other benefits. This guide provides insights about customer lifetime value, how to calculate this metric, and more useful information about CLV that business owners and managers should know. Customer lifetime value, CLV, is a measure of the total income a business can expect to bring in from a typical customer for as long as that person or account remains a client. When measuring CLV, it's best to look at the total average revenue generated by a customer and the total average profit. Each provides important insights into how customers interact with your business and if your overall marketing plan is working as expected. For a more in-depth look, you may want to break down your company's CLV by quartile or some other segmentation of customers. This can give greater insight into what's working well with high-value customers, so you can work to replicate that success across your entire customer base. There are multiple definitions of CLV. Basic calculations that only look at revenue, and more complex equations that factor in gross margin and operational expenses like COGS, shipping, and fulfillment. Marketing expenses can be included but are sometimes left out if they are too variable. For the sake of simplicity, we're using revenue throughout this article. Customer lifetime value, CLV, is a measure of the average customer's revenue generated over their entire relationship with a company. Comparing CLV to customer acquisition cost is a quick method of estimating a customer's profitability and the business's potential for long-term growth. Businesses have several marketing tools to help them improve CLV over time. Looking at CLV by customer segment may offer expanded insights into what's working well and what isn't working as well for your organization. Customer lifetime value boils down to a single number, but there may be significant nuances. By understanding the different parts of your CLV, you can test different strategies to find out what works best with your customers. Thanks to its simplicity, CLV can be an important financial metric for small businesses. For example, let's examine how a grocery chain may look at CLV. Based on data in the company's ERP system, it can see that the typical customer spends $50 per visit and comes in an average of once every 2 weeks, 26 times per year, over a 7-year relationship. The grocer can find its CLV by multiplying those three numbers, 50 by 26 by 7, for a value of $9,100. But why does that number matter? We'll dig into the details in the next section. Customer lifetime value, or CLTV, is the present value of the future cash flows or the value of business attributed to the customer during his or her entire relationship with the company. CLTV is the value a customer contributes to your business over the entire lifetime at your company. It is a very important metric and is used while making important decisions about sales, marketing, product development, and customer support. By applying customer lifetime value, marketing managers can easily arrive at the root p-value associated with the long-term relationship with any customer. It is difficult to predict how long each relationship will last, but marketing managers can make a good estimate and state CLTV as a periodic value. It is useful metric used by marketing managers especially at a time of acquiring a customer. Ideally, lifetime value should be greater than the cost of acquiring a customer. Some also call it a break-even point. The basic formula for calculating CLTV is the following. Average order value, X, number of repeat sales, X, average retention time. For example, let's say you run a health club where customers pay 1,000 rupees per month and the average time that a person remains a customer in your club is 3 years. Then the lifetime value of each customer is, according to the formula above, 1,000 rupees per month x 12 months x 3 years equals 36,000 rupees. This means each customer is worth a lifetime value of 36,000 rupees. Once we calculate CLTV, we know how much the company can spend on paid advertising such as Facebook ads, YouTube ads, Google AdWords etc. in order to acquire a new customer. Customer lifetime value, CLV, lifetime customer value, LCV, or user lifetime value, LTV, is the dollar value of a customer relationship, based on the present value of the projected future cash flows from the customer relationship. Customer equity is simply the total combined CLVs for all of a company's customers. Customer lifetime value encourages firms to shift their focus from quarterly profits to the long-term health of their customer relationships. Customer lifetime value is an important number because it represents an upper limit on spending to acquire new customers. The purpose of the customer lifetime value metric is to assess the value of each customer. As Don Peppers and Martha Rogers are fond of saying, some customers are more equal than others. Customer lifetime value, CLV, differs from customer profit or CP, the difference between the revenues and the costs associated with the customer relationship during a specified period, in that CP measures the past and CLV looks forward. As such, CLV can be more useful in shaping managers' decisions but is much more difficult to quantify. While quantifying CP is a matter of carefully reporting and summarizing the results of past activity, quantifying CLV involves forecasting future activity. Customer lifetime value, CLV, the present value of the future cash flows attributed to the customer relationship. Present value is the discounted sum of future cash flows. We discount, multiply by a carefully selected number less than 1, future cash flows before we add them together to account for the fact that there is a time value of money. The time value of money is another way of saying that everyone would prefer to get paid sooner rather than later and everyone would prefer to pay later rather than sooner. The exact discount factors used depend on the discount rate chosen per year as an example, and the number of periods until we receive each cash flow. Dollars received 10 years from now must be discounted more than dollars received 5 years in the future. The concept of CLV is nothing more than the concept of present value applied to cash flows attributed to the customer relationship. Because the present value of any stream of future cash flows is designed to measure the single lump sum value today of the future stream of cash flows, CLV will represent the single lump sum value today of the customer relationship. Even more simply, CLV is the dollar value of the customer relationship to the firm. It is an upper limit on what the firm would be willing to pay to acquire the customer relationship as well as an upper limit on the amount the firm would be willing to pay to avoid losing the customer relationship. If we view a customer relationship as an asset of the firm, CLV would present the dollar value of that asset. One of the major uses of CLV is to inform prospecting decisions. A prospect is someone whom the firm will spend money on in an attempt to acquire her or him as a customer. The acquisition spending must be compared not just to the contribution from the immediate sales it generates but also to the future cash flows expected from the newly acquired customer relationship, the CLV. Only with a full accounting of the value of the newly acquired customer relationship will the firm be able to make an informed, economic prospecting decision. The CLV model has only 3 parameters: constant margin, contribution after deducting variable costs including retention spending, per period, constant retention probability per period, and discount rate. Furthermore, The model assumes that in the event that the customer is not retained, they are lost for good. Finally, the model assumes that the first margin will be received, with probability equal to the retention rate, at the end of the first period. The one other assumption of the model is that the firm uses an infinite horizon when it calculates the present value of future cash flows. Under the assumptions of the model, CLV is a multiple of the margin. The multiplicative factor represents the present value of the expected length, number of periods, of the customer relationship. When retention equals 1, the customer is always retained, and the firm receives the margin in perpetuity. The present value of the margin in perpetuity turns out to be the margin divided by the discount rate. For retention values in between, the CLV formula tells us the appropriate multiplier. Customer lifetime value, CLV, is the total predictable revenue your business can make from a customer during their lifetime as a paying customer. For instance, if a customer subscribes to one of your products under a 1-year plan, at that time, the lifetime of that customer is 1 year long. Their lifetime value will be the amount you expect to make in that year. Hence, the longer the customers stay and the more often the customer buys from you, the greater will be their CLV. If you can determine the profile of the customers that produce the highest CLV, you can use those profiles to acquire more customers that closely resemble those existing high-value customers. Identify high-value customers. Businesses don't want to spend their money and resources on acquiring customers that will not be profitable. They want to know how much they should invest in marketing activities that will attract the best customers. But what does best customer mean to them? There are different answers to this: customers who are the most loyal, customers who are the most profitable, customers who are easier to attract and retain. Well, how about all of the above? These are called high-value customers or customers having high customer lifetime value, CLV. By calculating the CLV of each customer and ranking them by the results, you can identify the high-value customers. The higher the CLV, the more valuable the customer. Hence, measuring CLV helps you to knowledgeably build out your product, tailor your marketing and sales activities to maximize the likelihood of acquiring and retaining such high-value customers. Invest in the acquisition. Nothing bogs down a business faster than spending more money to acquire customers than you receive once they've signed with you. That's why understanding how your CLV relates to the customer acquisition cost is important. While CAC answers how much it costs to acquire a new customer, the CLV reflects the other half of the equation: how much is a customer worth? The balanced ratio of these two metrics answers the ultimate question: what is the true value of the customer to my business? Together, the metrics answers the ultimate question: what is the true value of the customer to my business? Together, the metrics CAC and CLV represent a prototypical return on investment, ROI, a business can gain from an acquired customer, and helps to check whether the investment levels are sustainable for long-term business viability and value creation. Brand loyalty is one of the important and most challenging strong points for a business to achieve. The CLV provides a better dimension to customer relationships by making businesses aware of a customer's worth, especially those considered loyal having high CLV. High CLV customers are loyal customers, and they offer your company many benefits. They stick with your business longer and offer valuable feedback as they grow with you. Those customers become the best brand advocates, giving you good word-of-mouth referrals that hugely help in building your brand reputation. Hence, focusing on improving your CLV through different loyalty initiatives plays a significant role in driving customer engagement and building strong brand loyalty. As a business owner, there are dozens of important metrics you need to both track and understand. From your net profit margin to sales revenue and retention, these critical metrics help you stay on track as you grow and scale your business. Not tracking the right metrics is a dangerous road to walk, as it can lead you to some unsuspected surprises throughout your business journey. One of the most important metrics you'll want to pay particular attention to relates to your customer lifetime value. This metric tells you what you can expect from an average customer over the course of your business relationship. In this guide, we'll walk you through exactly what customer lifetime value is and why it's important, as well as show you how to calculate customer lifetime value, CLV. The CLV of a Honda owner might be as much as $100,000 if they are happy with their car or minivan choice and end up buying several through the years. Or the CLV of a regular coffee drinker might be even higher than that, depending on how many cups of coffee they drink a day and where they buy it. Conversely, someone who buys a home twice in their life might be worth only, say, $15,000 to a real estate agent, because while the value of the purchase is huge, the percentage paid to an agent is only a fraction of the total. In the big picture, customer lifetime value is a gauge of the profit associated with a particular customer relationship, which should guide how much you are willing to invest to maintain that relationship. That is, if you estimate one customer's CLV to be $500, you wouldn't spend more than that to try and keep the relationship. It just wouldn't be profitable for you. If you understand your CLV well, that can help shape your business strategy to keep loyal customers, rather than investing the resources in acquiring new ones. Of course, new and current customer play an important role in business building in general. Calculating the CLV for different customers helps in a number of ways, mainly regarding business decision-making. Knowing your CLV, you can determine, among other things, how much you can spend to acquire a similar customer and still have a profitable relationship. The exact amount you can expect an average customer to purchase over time. What kinds of products customers with the highest CLV want. Which products have the highest profitability. Which customer relationships are driving the bulk of your sales. Who your most profitable types of clients are. Using your CLV as a base, you can work to better understand your most loyal customers. What do they like? Why do they continue to purchase from you? Together, these types of decisions can significantly boost your business profitability. As with any metric you track in business, knowing the number is not enough. You have to use your CLV to shape your overall business strategy. If your customer lifetime value is on the rise, that could mean you should continue to invest in product development or your customer success teams. If your CLV is declining, that might tell you your latest marketing strategy could use a reboot. One of the main benefits of understanding CLV is that it can help you significantly reduce your customer acquisition costs over time. Boosting customer lifetime value. Since the odds of selling to a current customer are 60% to 70%, according to eConsultancy, and the odds of selling to a new customer are 5% to 20%, investing your resources in selling more to your existing customer base is the key. In most cases, it's far easier to sell to existing customers than it is to invest in acquiring new customers. So what tactics will increase the likelihood of a customer buying more from you? How can you increase your average order value? Make it easy for customers to return items they've purchased from you. Making it hard or expensive will significantly reduce the odds of them making another purchase. Make strategic exceptions for your most loyal customers. For example, if someone is planning on canceling a subscription service you offer, give them an option of remaining a user with a small discount. Interview and connect with your best customers to understand why they continue to choose your brand. Set expectations regarding delivery dates, aiming to underpromise and overdeliver. It's much better to promise delivery by August 1st and have it in their hands by July 20th than the reverse. Create a rewards program to encourage repeat purchases, with rewards that are both attainable and desirable. Offer freebies for doing business with you to build brand loyalty. Run exclusive deals only for existing customers. Use upsells to increase the average value of a customer transaction, which is the equivalent of McDonald's asking, "Would you like fries with that?" Stay in touch. Long-time customers want to know you haven't forgotten them. Make it easy for them to reach out to you as well. By using CLV to shape your business strategy, you'll ultimately build a more profitable, successful business by focusing on attracting and retaining long-term customers who will become advocates for you, as well as repeat buyers. Understanding CLV allows you to make informed decisions based on how long a customer typically buys from you and what they spend over the lifetime of the relationship. This metric can help inform your strategy on customer acquisition, retention, customer service, and even the quality of your products and services. While the formula can be a little more complex if needed, The most basic way to calculate CLV is as follows: the average value of a purchase X number of time the customer will buy each year, 10 average length of the customer relationship in years. Thank you for watching the video and subscribe the channel.